National Treasury has warned that allegations of organized crime links within senior police ranks could undermine South Africa's standing with the Financial Action Task Force during its next evaluation. Treasury official Ismail Mamoniat says law enforcement remains the country's biggest vulnerability, with the FATF set to scrutinize South Africa's record on investigations, prosecutions, convictions and asset recoveries linked to financial crime. South Africa was removed from the FATF grey list in 2025, but a tougher review is already underway and will conclude in 2027. To avoid another grey listing, Treasury is rushing through legislative reforms aimed at strengthening anti-money laundering measures. South Africa's financial system has become more vulnerable since the outbreak of the Middle East conflict, and that's according to the Reserve Bank. It cited higher oil prices, rising inflation and tighter financial conditions as pressure points for households and businesses. The bank says that while South Africa remains resilient with major financial institutions well capitalized and liquid, weaker growth, elevated fuel costs and volatile capital flows will continue to test the economy. The SARB added that the conflict has reduced the likelihood of interest rate cuts this year, with its latest forecasts now pointing to the possibility of another rate hike. Mineral and Petroleum Resources Minister Gwede Mantashe says government wants to increase South Africa's strategic fuel reserves to the equivalent of 60 days of net imports. Now that's up from the current reserve capacity of about 21 days. The proposal forms part of a new strategic petroleum stocks policy aimed at protecting the economy from global supply disruptions and geopolitical shocks. Now, Mantashe says South Africa's growing dependence on imported fuel has increased energy security risks and that the new South African National Petroleum Company will play a key role in building reserves and supporting local oil and gas development. SACCI says business confidence showed a slight recovery in May, and that's after a sharp decline in April. The Business Confidence Index rose by half a point to 124.1, helped by stronger vehicle sales and merchandise exports. Now, confidence remains 8.3 points higher than a year ago, but businesses are still concerned about inflation, energy costs, and the impact of high crude oil prices. SACCI says a steadier rand and lower fuel levies have helped soften some of the pressure, while rating agencies remain cautiously positive on South Africa's economic outlook. South Africa's mining sector recorded a stronger than expected performance in April. Production increased by 8.2% year-on-year, marking a fifth consecutive month of growth and coming in ahead of market forecasts. Now, the biggest contributor came from platinum group metals, where output surged nearly 37%. Manganese and chromium ore production also recorded strong gains. Coal, diamonds and copper were among the commodities that weighed on overall performance. The manufacturing sector, meanwhile, remained under pressure in April, despite signs of resilience in sales activity. Manufacturing production declined 2.9%, marking its steepest decline in a year. The biggest drags came from metals and machinery, wood and paper products, and the vehicle manufacturing sector. Alex Forbes has reported a strong set of annual results. Normalized profit from operations rose 22% to just over R1 billion, while operating income ticked up 10%. Total assets under management and administration increased 22% to R733 billion. CEO Dawie de Villiers says it was another solid year of performance, with the group benefiting from strong execution, high client retention, and continued investment in technology and advice-led services. The company has upped its total annual dividend by 4% to 57 cents a share. Looking ahead, Alex Forbes says it expects economic and geopolitical uncertainty to persist, but it remains confident that disciplined execution, technology investment, AI adoption, and growth in its retail and investment businesses will support sustainable long-term earnings growth. Ceres Real Estate has successfully raised 185 million euros through taps of 2 existing corporate bonds, taking both issuance to the 500 million euro benchmark size. The company says the proceeds will be used for general corporate purposes and to refinance existing debt. Chief Financial Officer Chris Bowman says the transaction demonstrates continued support from capital markets for the group's strategy and property portfolio, while providing additional financial flexibility. The JSE has lifted the suspension of Wesizwe Platinum's shares with immediate effect. The company was suspended in June last year after failing to publish its audited annual financial statements within the required timeframe. Wesizwe says it has been working to address the issues that led to the suspension. Further afield, Oracle shares have taken a beating after it revealed its AI infrastructure spending plans for next year. This package report details why it rattled markets. Let's take a look.
Oracle shares plunged. The dive came after the tech firm said its spending on AI would blow past estimates. It also said it would have to raise more debt next year, reflecting the staggering sums of money being put into AI infrastructure. Oracle has big deals to build data centers for customers like Meta and OpenAI. On Wednesday, it said its huge Stargate facility in Texas would be more than 3/4 complete within 90 days. OpenAI said customers can now access its cutting-edge coding models on Oracle's cloud. But the rising costs are giving investors the jitters. This year, Oracle says capital expenditures hit close to $56 billion, well above its target. In fiscal 2027, it says that figure will balloon to as much as $95 billion, though some of that will be repaid by customers. The company also said its profit margins would step down over the coming year as it ramps up data center projects. One analyst told Reuters that, while Oracle has real demand for its services, it was getting harder to see how it could fund all the investment required.